Investing in the stock market shouldn't intimidate you. Anyone can succeed. You have the skills and intelligence necessary. Education is not a prerequisite. What you need is patience and a willingness to do some research. Many successful investors have proven this point. For instance, Peter Lynch, who retired in 1990 as the manager of the Fidelity Magellan Fund, one of the largest and most successful mutual funds, achieved an extraordinary 2,800% return over his 13 years of management. Lynch is celebrated as one of the best money managers in history, not by timing the market, but by selecting the right stocks. While no one can guarantee Lynch's level of success, there is much to learn from his experience, and you don't need a massive portfolio to apply his principles. Hello, I'm Peter Lynch, and I managed the Fidelity Magellan Fund for 13 incredible years. During this time, the market declined by 10% or more on 9 occasions, and I remained consistent through all of them. I learned valuable lessons that are as relevant today as they were 2 decades ago, and I'm here to help you become a better investor. It's important to understand that mastering stock picking takes time, but you might be more skilled than you realize. You have unique advantages that professionals on Wall Street do not possess, and I'm here to help you identify and leverage them. You might wonder why investing in stocks is essential for long-term growth. The answer is straightforward. Over time, stocks yield better returns than other investments. Historically, stocks have returned around 10% annually over the past 60 years, compared to 6% for bonds and about 3% for treasury bills or bank CDs. Although these differences might seem minor, the power of compounding can make a significant impact over time. For instance, if you invest $50 a month at a 6% return, after 30 years, you'd have over $50,000. Keep in mind that taxes can diminish your return, so it's wise to invest in tax-deferred accounts like IRAs, 401(k)s, or 403(b)s if you won't need the funds until retirement. The longer you let your money grow, the greater your returns will be. Consider this: a 20-year-old who invests $200 a month at a 10% return could accumulate $1.1 million by age 60, while a 35-year-old would need to invest $800 monthly to achieve the same amount. If you require access to your money within a short time frame, investing in stocks may not be appropriate, as the stock market is volatile. Individual stocks can fluctuate significantly, with an average yearly range of 50% between highs and lows. If you have a short investment horizon, say 1 to 2 years, investing in individual stocks or equity mutual funds could be risky. Looking back, in 1987, the S&P 500 fell 33% from its August peak to its October bottom. Those who could withstand that downturn found that from 1987 to 1992, the S&P still outperformed treasury bills and long-term government bonds. If you want to double your money quickly and safely, the best advice is to fold it in half and put it in your wallet. Any other method is essentially gambling. Good stocks may take 2, 3, or even 5 years to pay off. My best performing stocks took 5, 6, or 7 years to show their full potential. Many investors ask when to sell a stock. The decision to sell should involve comparing the narratives of the stocks you hold. If one story is more compelling than another, consider selling the lesser story to invest more in the better one. When you own several companies, you are essentially playing multiple games of poker, so focus on those with the best chances of success. Remember, however, that these narratives do not change overnight. It may take years for a good investment to be recognized by the market. Your unique experiences as a consumer, professional, or neighbor can provide you with an edge in stock picking. Leverage these advantages to identify promising stocks. You possess several inherent qualities that make you a capable investor, including insights from your field of work or your local community. For example, if you notice that a product you love, like a Volvo, is superior to its competitors, that can be a starting point for your research. My experience in the mutual fund industry taught me valuable lessons about recognizing potential stocks. I missed opportunities with companies like Dreyfus, Pioneer, T. Rowe Price, and Franklin Resources when the mutual fund industry took off in the 1980s. Take the story of a New England fireman who observed a local factory expanding and decided to invest in Tam brands, now known as Tampax. By 1972, this fireman became a millionaire, demonstrating that investing is often a personal endeavor. You have to navigate the market on your own, requiring emotional resilience to handle its inherent volatility. The key factor in successful investing is not just intelligence but also the capacity to withstand market fluctuations. Before you invest, ask yourself when you'll need to access this money. The stock market is primarily a long-term investment. If you anticipate needing your funds in the near future, consider avoiding stock investments. The capital you are willing to invest should be earmarked for the market for 5, 10, 20, or 30 years. This is the type of money that can thrive in the market. If you're anxious about potential losses, it's best not to invest. The stock market and individual stocks are inherently volatile. Historically, there have been 50 declines of 10% or more in the last 95 years, with 15 of those being drops of 25% or more. On average, the market falls 10% every 2 years and 25% every 6 years. These fluctuations are part of the market's nature. For example, during the 1990 market crash triggered by Saddam Hussein's invasion of Kuwait and subsequent banking troubles, many strong companies saw their stock prices drop despite their fundamentals remaining intact. Such declines present excellent buying opportunities for strong companies at lower prices. Ultimately, every stock represents a company. A company that performs well over the long term will see its stock perform well as well. If you believe in a company's long-term prospects, it's wise to invest. If you start to see warning signs indicating a decline, the stock will likely reflect that quickly. When analyzing stocks, it can be overwhelming to consider the vast number of options, over 3,000 on the New York Stock Exchange and more than 13,000 public companies in total. To simplify your research, categorize stocks. This organization helps you understand what kind of questions to ask about a company, as different stocks behave differently. Avoid rigid rules like selling after doubling your investment or selling when a stock drops 10%. Such formulas do not apply universally. You can broadly categorize stocks into 5 types: fast growers, slow growers, cyclicals, asset plays, and turnarounds. These categories serve as guidelines rather than strict rules, as many companies may not fit neatly into one category. Fast growers, for instance, typically see earnings grow at rates over 25% annually, allowing their profits to double in 3 years and quadruple in 6.